1 second. Perfect. So welcome everybody. Thank you very much for tuning into this session. We're really glad to have you with us at this second edition of the Climate Adaptation Research Symposium. And with that, let us get right into it. So first of all, thank you once again to our collaborators and sponsors making this event possible. Just as a quick note, I think the widgets that you are seeing should be resizable and movable. I think this is one note that I should share with you guys. If there are any issues, then I think you can also post questions into the chat, and then we'll try to connect you with somebody who can assist with technical questions. Okay, so this session is all about climate change, finance, and policy, and we have 4 excellent papers on the program that cover different aspects related to this topic. And the only housekeeping item that I would want to share before we get started is please make use of the Q&A function. So if any questions come up, then please ask them in the chat, and we make sure that we cover them after the presentations. Great, but with that, I would say let's save as much time as possible also to have that space and get right started with the first presentation by Jean-Stéphane Mésonnier from the Banque of France. Jean-Stéphane, I'll try to hand it over to you here.
Hello, can you hear me? Can you see me? Yeah. So good morning or good afternoon, everybody. Here in Paris, it's late afternoon. Let me first thank the organizers for including our research in this terrific session. So I'm very glad to be here. And I'm presenting today a paper called dealing with mandatory climate-related disclosure by financial institutions and the impact of such disclosure. It's a joint work with a colleague at Banque de France, Benoît Nguyen, and of course the usual caveat applies for central bank researchers. So the opinions that we express here are our own and not the responsibility of the French central bank. So I have only 15 minutes, so I'll try to be focused and convey the main messages most efficiently. Just a few words of motivation for this research first. So, as you know, it won't be possible to reach our global climate targets, and including reaching net zero by 2050. Without a global shift of financing out of carbon-intensive industries and companies into low-carbon activities. So there's agreement about this requirement. So it's clear that this needs to be done. How to achieve this is quite difficult, and there are many possible ways. So one large part of the debate so far, following a seminal speech by Bank of England Governor Mark Carney in 2015, a lot of the debate has revolved about the potential associated with improving the transparency of financial institutions regarding the climate footprint or the climate-related policies. When it comes to improving the climate-related transparency of financial institutions, there are 2 possibilities. On the first hand, we've seen new private coalitions for sustainable finance, like the TCFD or many other groups, which support a voluntary disclosure of information related to these elements. But in parallel, we've also seen a move from regulators globally towards making such disclosure by financial institutions mandatory. France has pioneered the way, as we will see, but no such regulation is being implemented in the EU. It's being debated in the US, and recently the G7 group endorsed mandatory reporting following the guidelines set up by this group of this coalition of the willing called TCFD. So the main question facing that is what could be the benefits? What should we expect of making such carbon disclosure mandatory by financial institutions instead of letting them doing it voluntarily. Okay, so in this paper, we narrow a bit the question and we ask whether obliging financial institutions to improve on their climate-related disclosure has an impact on their funding of carbon-intensive industries. To get an answer, we construct an econometric test where we use some recent regulation in France as a natural experiment. This regulation is a law which was voted in 2015, just before the Paris Agreement, and which was enacted in January 2016. This law is called the law in English, it's called Law for the Energy Transition for Green Growth, in French TECV, but it's most famously known by investors as being the Article 173.6, which is this specific provision in the law that makes climate-related disclosure by financial institutions in France mandatory. So that's the objective of this special provision we're interested in. When I say financial institutions, I need to be more precise, because in fact the target of this regulation is not all institutions, but what we call institutional investors, insurance companies, pension funds, investment funds, but not banks in France. And very importantly for our purpose and for our experiment, this regulation was unique in Europe when it was implemented starting from 2016. Okay, so we have an experiment and we want to gauge the effect of this new law on something. What? Our metrics is quite simple. We look at changes in the portfolios of financial institutions, and more precisely at changes in holdings of securities issued by fossil energy companies, what I will call fossil energy securities throughout, like bonds and stocks issued by such companies. The reason for that is clear. So this is something that you can quite effectively measure. It's less debatable than other measures like temperature alignment programs. And of course, burning fossil fuels is responsible for the bulk of climate change, and it's very much scrutinized by the public opinion. So our hypothesis is that this regulation that forces some institutional investors in France to be more transparent regarding their climate impact and policy provides incentives for them to cut priorly their funding to fossil fuel companies. Okay. So how do we perform our experiment? We collect a vast amount of data. So we merged two large, very granular data sets over the period from 2013 to 2019. So on the one hand, we reconstruct the whole universe of all bonds and stocks issued by fossil fuel companies over this period of time and outstanding over this period of time. And on the other hand, we use a proprietary data set by the Eurosystem, which gives us detailed information on which security, identified by a so-called easing code, which security is held by each institutional sector in whatever country. For instance, which security is held by banks in Spain, or households in Germany, or insurance companies in France. In the following, we focus on the portfolios of all types of financial institutions, but we abstract from households and etc. In our finance sample, we have more than 7,000 securities. 2/3 of them are bonds, 1/3 stocks, which had been issued by roughly 3,000 different fossil fuel companies, and which were held at some point at least over this period of interest by Euro area financials. And then we get this very rich data set and we exploit this data set. Basically, what our econometric exercise does is the following. We compare through times, before and after the French law, the behavior of two different groups of agents. So on the one hand, the one that we call treated, which are these institutional investors in France, and on the other hand, French banks, which are not treated by the regulation, and all other financial institutions in the other countries of the euro area. Okay? And we control for all potentially confounding factors thanks to our econometric setup. The main findings are that indeed it worked. So making climate-related disclosure mandatory caused a significant decrease in the funding by French institutional investors, the funding of fossil energy firms. Everything else being equal, of course, so it's a relative reduction. This relative reduction is quite sizable, and we show that it's robust to many potential caveats. Okay? So let me now go a bit. So let me skip that because it's because of time. I can show you first a few to set the back to set the context. I can show you a few aggregates that we can construct using our data set. First, we have here a view of the cumulated fundings of fossil firms, fossil energy firms worldwide by euro area investors in all sectors. So you see it's slightly on the rise, and at the end, in 2019, it's about it makes about 600 billion euros. Most of this investment is indeed done by financial institutions of different types, and among them, in yellow, asset management firms dominate. Okay, and then I show you kind of intuition of the phenomenon we are looking at. So here, we use the raw data set, but we just cumulate the holdings by institutions in one group versus in the other group. So in blue, the treated institutions, in green, the other controlled institutions, so these financial institutions that are not treated by the French regulation. Everything is based at 100 in 20 at the time the law is implemented. And we see that indeed, in relative terms, the profile of these portfolio holdings by treated institutions, holdings of fossil fuel securities, trends below the profile of the holdings by others. So to make our case, we need, of course, to run more structured econometric tests. That's what we do. So we estimate equations of this type, where we're interested in this coefficient, which give us a measure of the average relative effect of being treated on holdings of individual securities issued by fossil fuel companies. So we have this estimate, which is quite robust depending on whatever the type of controls we use. And we can translate it in economic term by an average reduction of holdings of fossil securities by the treated financial institution by some 40%. Okay, and this additional graph went similar regression, but allowing for time variation in the effect. And we see that, of course, there was no effect of the law before the law, but there was a quite persistent effect afterwards. Okay, so I have no time to develop all our tests for robustness, but you may trust me that these results are qualitatively robust to several standard tests that we can think of. Okay, and then in the paper that you can find on the internet on SSRN, we also make further steps and also show that we have differentiated effects of this French regulation, when we compare the effect between different types of fuel, so the effect is stronger on holdings, portfolio holdings of securities issued by coal firms or unconventional fuel firms. The effect is stronger for holdings of stocks than for bonds. And the effect is also stronger whenever the issuer of the fossil fuel security is a non-euro area firm. So there is, in other words, a strong domestic bias in the reaction of these portfolios. And the last part of the paper, we use an auxiliary data set at the firm level. So here we consider things at the level of the individual fossil fuel companies. And the idea that we want to test is whether at least in a way, when these companies when treated investors, French investors treated by the French law have a higher stake in these companies, did this have an impact on the way these firms behave, and in particular on the probability for these firms to adopt more ambitious CO2 emission reduction targets. So that's what this table means, and basically what this coefficient tells us is that indeed, whenever after the law, the probability for firms owned by the investors treated by the French regulation, the probability for these firms to adopt emission reduction targets is higher. So it seems that this law, indeed, through impact investing by the treated investor, also had some real effects. So let me conclude. Our conclusion is that making climate-related disclosure by investors mandatory may be a really useful tool in order to curb funding of fossil energy industries and companies. So clearly, our results call for an extension of the French type regulation to many types of financial investors and in other countries, and as far as France is concerned, at the EU level. So voluntary coalitions like the TCFD and others may help, but they're not necessarily enough to wipe out the effect of regulation over time. And yes, that's it. And of course, if you have questions, I'd be glad to answer them afterwards. Thank you.
Thank you, Jean-Stéphane. Excellent presentation. I apologize. I'm again not sure whether my audio works fine. Yes, and we already do have a question in the chat. So maybe I thought it might be good to add as well, though, that since this is an interdisciplinary symposium, please feel free to ask questions from any potential angle. And I think questions related to the details of the paper as well as to the big picture question underlying the study are really welcome. All right, so please keep thinking about what might come up for you. In the meantime, we can jump to the first question, which comes from our next presenter, Phan. And he's asking, so to Jean-Stéphane, whether there could be leakage. And the type of leakage that he's thinking about is, that is, fossil fuel securities simply go from treated institutions to untreated ones. How can you potentially detect this type of leakage? And is there anything in terms of the differences methodology that can help to address that? The question whether it can address that.
Yeah. Can I take 1 minute to answer?
Yes, please. Yeah.
Yes.
More potentially.
It's a very relevant question. Of course, there can be leakage. So that's the reason why we clearly call as a conclusion to an extension of such regulations to the major financial places. So with this methodology, as you guess, in fact, it's not possible to measure such leakage because what we do is measuring the impact on the treated in relative terms. So we don't really know in absolute terms what happens to others. Nevertheless, if you look at the paper, when you look at some of the robustness checks, you will see that removing some other important financial centers from the, well, we have some other results that suggest that at least the leakage was not to financial centers we may have expected, like, for instance, Luxembourg. So it's more tricky than that, if there is some.
Great. Yeah. I think that's helpful to know. Another question that came up here was whether the slides are going to be made available. To be honest, I don't know, but I'll find out, and then we'll clarify that throughout the session. Let me quickly take a look at the time. I think we would have space for one more question, so maybe we'll just wait a moment whether something else comes in.
I don't know about the slides, but the paper is on the internet, so in particular on SSRN.
Excellent. So that would be another opportunity to look into the details. Okay, so if nothing else comes up, I would say thank you very much once again. And then we move on to the next presentation, which is Toan Phan from the Federal Reserve Bank of Richmond. Toan, the floor is yours.
Thank you, Nora. Thank you, the organizers, for having our paper on the program, because it is an interdisciplinary environment. So let me, I will start with the big picture. So first of all, this paper is joined with Philippe Schwartzman. He's also in the audience. Obviously, our views is our own views, not views of the Feds. Its paper is Climate Defaults and Financial Adaptation. So let me, as like I said, the big picture we have here is that we were looking at climate economics through the lens of macro finance economists, in particular after the lessons from the great financial crisis. So our general agenda is to understand the roles of financial frictions in climate economics. So the context here is that after the great financial crisis, there's a vast literature in macro finance that document the importance of financial frictions in amplifying and propagating shocks. So a particular very important example was how the initial subprime losses was relatively small relative to the economy. However, it was amplified and propagated through the reactions in the financial system that led to a prolonged and deep global financial crisis and the recessions that followed. So, however, the kind of financial frictions here are largely absent from the current climate economic literature, especially the kind of integrated assessment models that have been used a lot for policy. As a consequence, potential amplification and propagation of direct climate damages are largely understudied. Another thing is incorporating financial frictions to climate models could potentially also help us to understand pressing policy questions, such as whether the climate risk could have some effect on financial system stability, or are there implications to financial policies, right? So that's the big picture we have. Now, zooming into this particular paper, so we will consider a relevant financial friction, sovereign default risk. So in the session today, we have 4 papers, so 2 papers ourselves, and then later Enrico will talk about sovereign default risk. So, and this particular thing, our project, we try to understand, to develop a theoretical framework so that we can understand, number one is the roles of default risk in small developing economies that are exposed to climate-related disasters. Okay, this is a pressing question for many countries, including from Vietnam, where I'm from. And then another secondary point is that we use a framework to understand the potential roles or benefits of financial adaptation, such as adopting disaster insurance or issuing catastrophe bonds, right? And this is different from physical adaptation, like building levees, that the literature has focused a lot on. So financial adaptation is less studied in the climate economics literature. So our methodology is to develop a small open economy growth model with sovereign default risk and with disaster risk. Okay, so our model is intentionally tractable, so that we can understand analytically what are the forces in the model, and we can generate theoretical predictions that we can evaluate against existing empirical patterns that the literature has documented. At the same time, the model is quantifiable. In fact, we will show you how we calibrate to estimates of cyclone damages and try to think of how potential effects of climate change. So just a quick overview. The main findings of the paper are as follows. So there is a vicious investment and default cycle. In particular, in the model, we have that when disaster hit, that destroy a lot of capital stock, that will lead to reduction in the country's net worth. And this, in reducing net worth, reduce the country's ability to make capital investment. So capital investment goes down. That leads to increase in default risk. Because, however, the increase in default risk make it more expensive for the country to borrow. So feedback to the reduction in capital investment. So this red feedback loop here is important because this vicious cycle will significantly delay the recovery, as illustrated in this picture here. This is coming from the simulation in the paper. So this plotting in the output, so think of GDP per capita, after a disaster. The disaster hit in period 0. That obviously mechanically reduced capital stock and reduced output. In the absence of financial friction, capital would flow into the country, allow the country to rebuild the capital stock. So without financial friction, the country would simply bounce back to the previous pre-disaster level of output. However, with financial friction, these vicious cycles I mentioned to you, the recovery will be quite delayed. In this calibration, it can be decades. And this pink shaded area here can represent to you in a simple way, illustrative, the additional output losses due to the presence of financial friction. So it gives an example of how financial frictions matter in propagating climate-related disaster cost damage. Okay, and then finally we show that in a calibrated example, financial adaptation to climate change could potentially reduce some welfare loss, but the effect is moderate. So for the benefit of time, I skip the literature review. I'm go straight to the model in a nutshell. So as I mentioned, this will be a small urban economy. They have a representative government and with absentee preferences. So the reason is because it's well known in the literature that to capture the full effects of disaster risk, this kind of preferences will be better. So we have absentee preferences. The country's production is GDP per capita here. Why? It's going to be production coming from capital stock. Labor is normalized to 1 to make life simple. K is standard capital stock. A is the TFP process. That's typical, and alpha is the capital share. The only difference here is that there can be climate-related disasters. You can think of cyclones throughout. Cyclones, if they strike, they won't cause damage. Okay, so disaster damage will be represented here in this term here. The details in the paper, but just think of like disaster can reduce the capital stock. Okay, so these are capital destroying disaster. And then so the instruments here, the financial instruments here is that the government is active in the sovereign debt market. It can issue non-contingent one-period bonds to risk-neutral for lenders. Okay? So we model it in a very simple way. And also to further simplify our analysis, we're going to assume that the following default cost. Okay, so the country cannot commit to repaying its debt. That is key friction. Okay, no lack of commitment. If it was to default on foreign lenders, it will suffer the following cost. It will lose an exhaustion fraction L of output. This is output loss. Okay, and we assume away credit exclusion. Okay, so given these simplifying assumptions, we will get a very nice result. Is that the bond pricing, the price of the sovereign bonds that are issued by the government can be priced in a very closed form way here. So bond price, each unit of bonds issued in period T. It's going to be sold at the following equation. So R is the world's risk-free interest rate. Think of the interest rate from the US. So there's 1 plus R is the standard interest rate if there's no default risk. However, with default risk, there is a risk premium, and so there's a spread. So this red term in this equation here is showing you the default probability, or simply the jargon is spread. Okay, so simply the probability that debt over GDP in the next period will exceed the threshold L, the fraction loss of output. Okay, so this default risk can be captured in a very simple closed form way. Okay, so this way will allow us to characterize the model. Okay, in particular, in the paper we show that there's several analytical results. So we show that in equilibrium, the default risk schedule or the spread schedule, which determines the borrowing cost, will be increases in borrowing. So that's a standard result. The more you borrow, the higher the default risk, the more expensive it is. It decreases with investments. So the more you invest, the more likely you have resources to repay. So therefore, the more you invest, the less default risk you're going to face. Okay. And number 3 is that the borrowing cost increases with disaster risk in the first order stochastic dominant sense. Okay. And the implication of this result is that emerging economies with more climate vulnerability. So countries exposed, for example, to higher cyclone risk will face, all else equal compared to other all else equal countries, so will face higher borrowing costs. And also they're going to face higher probability of debt crisis. Okay, and both of these implications actually consistent with the empirical findings in the recent literature in these papers over here. Okay, so that's the kind of first smell test of the model, and then we will calibrate the model. So just to give the big pictures, what are the key parameters we are calibrating? And this is a work in progress. So we calibrate a disaster process and damage intensity to match the state-of-the-art empirical estimates of cyclone damages coming from Xiang and Gina. We also recently got data from Banque and Barrage. We are processing this data to rerun this calibration ourselves. And then we calibrate the default cost, L, to match the average observed debt over GDP ratio of emerging economies, is roughly 50% of debt over annual GDP. Okay, and our period here will be 5 years. So I'm just going to show you the impulse responses to a shock to cyclone activity. So look at the first picture. It's telling you that so the country is in a steady state, aggregate steady state, and then period 0, a shock hits that increased the cyclone activity in that period by 1 meter per second. Okay, so it's a little blip, small increase. Okay, that's the of cyclone activity. So then the next picture is showing you the consequence implication to output of the country, right? Mechanically, when there's increased cyclone activity, output is going to go down because it destroy capital stock and therefore reduce output. The key thing, like I show you in the very introductory slide, is that the recovery of the output is very low, can protract. In this particular calibration, it shows can be in decades, right? So this very slow recovery, actually, it turned out to be largely consistent with empirical findings from Xiang and Gina. They found that cyclone shock, 1 meter per second cyclone shock, could reduce GDP per capita in many countries by even 20 years, right? And we recently, like I told you, we are running regression using data we just got from Banque and Barrage. We also find this very persistent effects of cyclone in the data. So the model is somewhat qualitatively consistent with this slow recovery. What's driving this slow recovery? What's the key thing is that look at the pictures, spread D and E, spread and default risk. Okay, both of them spike after the cyclone shock. Okay, so both the borrowing costs and the probability of default increase after the cyclone shock. And this, by the way, also consistent with the empirical findings in two recent papers. Okay, so this so the key takeaway here is that in the model with financial friction, spread and default cost is very sensitive to climate-related disaster risk, like a shock here, cyclone shock cause in spike in default risk and borrowing costs, and that's a consequence lead to in slow recovery, post-disaster recovery. Okay, so in this framework we can use this framework to understand the potential cost of climate change. So we assume cyclone risk will be increased by 20%. So using estimates from Emmanuel et al. Right? So and there are two forms of adaptations we think of financial adaptation here. Right? Assume that the country can optimally choose to have disaster insurance. So we assume for simplicity that it's sold at actuary fair price. And also an alternative option is issue catastrophe bonds, sovereign bonds that are contingent on disaster realization. Okay. I don't have time to go to the details, but I can show you the results. So for benefit of time, let's look at the long run, the pink, the highlighted boxes here. So in our model, the welfare loss from increased cyclone risk due to climate change is roughly about 3% of permanent consumption loss. Okay? Given in the context of the macroeconomic literature, this is substantial loss. Okay, for example, compared to the to the welfare loss from business cycles fluctuations, that's very well studied in the macroeconomic. This is a very significant welfare loss. Okay, and then within our framework, we can think of the potential gains from financial adaptation. Right? We find that insurance, disaster insurance, and usage of catastrophe bonds can reduce to a bit this welfare loss from climate change. So in particular, combined together, both using disaster insurance and issuing catastrophe bonds optimally can reduce this welfare cost of climate change about 10%. So instead of reducing welfare loss by 3% of consumption here, it reduces it by 3 minus 0.34%. That's what I'm saying. The usage of financial adaptation can only partially reduce the welfare cost of climate change. Okay. So just to conclude here, we provide a tractable and quantifiable framework to analyze the climate default risk. So that is the interaction between the physical risk of climate-related disasters and the financial risk of sovereign default. And we use it as to study financial adaptation. And then the main findings are that default risk significantly delays post-disaster recovery because of a vicious cycle between investment and default. And a significant welfare loss from increased cyclone risk in the calibration with financial friction. So it's showing the important roles of financial friction. And finally, we show that financial adaptation can help, but only to a degree. Okay, I think I'm out of time.
Actually, that was excellent time management. I think we're ahead of time. Thank you so much, Toan. And at the moment, the chat is still quiet. So we'll just say we take a moment to wait here. When in doubt, we could also take questions together with the questions about Ivan's paper, the next presentation. But again, maybe let's just take a moment to see if something still comes up in the chat on the Q&A section. At least I can see there's a room full of people, so please don't be shy if anything is to be clarified or comments related to this project.
And we also be around. You can answer the questions later as well.
Excellent. Then let's do that. So please keep thinking about it. If questions come up, then we take them after the next presentation. And otherwise, we just save some time here that we can make use of later on. So our next presenter is Ivanov from the Federal Reserve Board. Thank you very much for joining us again in the second year. Yeah, so Ivan, please go ahead.
Before I go any further, I should say the views expressed here are our own and not the views of the Federal Reserve. Okay, what's going on here? Sorry about that. Okay, so the main motivation for this paper stems from the debate on climate change and financial stability. These discussions have centered around physical and transition risks. Physical risks are those associated with intensifying and more frequent extreme weather events as a result of climate change. And transition risks are the financial risks which could result from the process of adjustment towards a lower carbon economy, as Mark Carney has put this very well. There's an obvious trade-off between these two types of risks. And just as a simple example here, if you increase transition risks, you're probably going to reduce physical risks. So banks are some of the largest stakeholders in the transition to a lower carbon economy. This is because mandatory emissions reductions could adversely affect the firms banks work with. And so in this setting, it is important to know whether climate change regulation is going to affect bank financial health and whether this may have like an impact on financial stability. So in this paper, we focus on prominent tool like climate change regulation, cap and trade programs. We study cap and trade bills as they move through the legislative process, which helps us isolate periods of high transition risks. It is also important to note here that the rules that we look at have heterogeneous impact on different firms, which would be important to identify the effect of cap and trade programs. So what we do in a nutshell is we analyze how banks manage exposure to affected firms, both public and private firms, to assess banks' expectations of the impact of these programs on firms. So overall, we show important empirical evidence that could be useful to the architects of cap and trade programs. Like more specifically here, we examine the California and the Waxman-Markey cap and trade bills, which happen over different time periods and affect firms in a different way, which helps us assess the external validity of what we're doing. So the first bill that we look at, the California cap and trade bill, was passed in 2011, at the end of 2011, and implemented in 2013. And this picture shows you two of the former governors of the state that were like very key in passing this this law. And so the second one, the Waxman-Markey cap and trade bill, this is the only bill at the federal level which had significant probability of becoming a law, was passed in the House of Representatives in June of 2009, and after high likelihood of making it through the Senate, ultimately failed in the summer of the next year. So to briefly highlight the findings before I go any further, so we show that banks gain flexibility to revoke credit in response to cap and trade regulation. We show that firms that are covered by the rules face shorter loan maturities, a lower share of term loans, higher rates of borrowing, but we don't find any effect on the loan amounts of these firms. These results are concentrated and come from the private firms in the samples that we look at, which means that banks expect these firms to face greater challenges in complying with the cap and trade regulation. Banks also appear to reduce transition risk exposure by selling loans on the secondary market. Okay, so in terms of the data for the study, we use two main data sources. For the first part of the analysis, we use data from the Federal Reserve's Y14, which covers both syndicated and bilateral loans that exceed $1 million in amount since 2011. These data are very rich and shows us all sorts of information about the loan contracts, which also includes interest rates for really small firms. The emissions data in the study comes from the EPA mandatory reporting of facilities that emit more than 25,000 metric tons of CO2 equivalents. This covers both direct and indirect emissions, and we then match these data to the Y14. So in the second part of the analysis, when we look at the Waxman-Markey cap and trade bill, since this bill occurred before the Y14 data was available, we use a different data set, the shared national credit data, which covers virtually the entire syndicated loan market, and it also includes private firms. And so these data give us a complete view of the lending syndicates, including non-banks on these syndicates. Okay, so in terms of the empirical strategy that we use in this paper for the first analysis, the California cap and trade bill, we have a very simple difference in difference analysis. which compares bank loan outcomes before and after when this bill passed. So basically we compared 2011 to 2012. And the firms, like in terms of firms that are affected by this law, we use the EPA data to figure out which firms have a large share of their emissions in the state. And we define affected firms in two ways. Firms that have at least 1/4 of their emissions in the state, or firms that have at least 1/2 of emissions in the state. So based on that, we have this simple specification, simple difference in differences specification. And here the main outcomes of interest, Y, are equilibrium outcomes of the loan contracting process between banks and firms. So this is loan amounts, total loan amounts for each firm at each point in time, as well as maturity and the fraction of term loans. So this coefficient lambda here would be negative if banks cut credit commitments or seek higher contract flexibility. Okay, so in terms of our main results here, you can see that we don't find any results whatsoever for loan amounts for firms that are affected by this bill after the bill passed. But we found significant effects for loan maturity and term loan share. So these results are economically significant and suggest that banks take steps to make sure they can reduce their exposure to the affected firms if firms are not able to comply with the law very well. So in the next part of the paper, we look at heterogeneity, the effect of the cap and trade bill on firms. We argue that these effects are likely to be different for public versus private firms. This is because private firms are smaller and then tend to be more financially constrained. There is also economies of scale in regulation compliance, which would also put private firms at a disadvantage. And last but not least, private firms tend to use older equipment and are less likely to be emissions efficient. So in line with this idea, in the last point, for the firms in our sample across the main sectors they operate with, we show that private firms are more inefficient than their public counterparts. So based on this, we split the sample into these two types of firms, and we show that our findings come from the private firms. So you can see that these results are much stronger in terms of these effects, and we don't find any results whatsoever for public firms in the sample. Okay, so finally, for this part of the analysis, we also look at the impact on loan rates, and we show that loan rates are significantly higher for the affected firms, and this result once again comes from the private firms in the sample. Okay, so the second bill we look at, as I mentioned earlier, is the Waxman-Markey cap and trade bill. We have a similar setting here. We compare bank loan outcomes before and after the bill passed in the U.S. House of Representatives to measure transition risks. And in terms of firms that we compare, we look at only manufacturing firms, and the firms that we argue would be more affected by this bill would be the ones that have energy intensity less than 5%. And since these are the ones that don't get free permits to emit greenhouse gases based on the rule. And so we basically look at firms that are around this 5% threshold. So in terms of the findings here, we find very similar results, even though this is a completely different setting. We find no effect whatsoever on loan amount for the affected firms. But in terms of loan maturity and the term loan share, we find effects that are similar in size to what we found in the California bill. So once again, these results here are for private firms. We find no effects whatsoever for their public counterparts. Okay, so we also consider different channels, other channels through which banks may manage transition risks. So, for example, one other way for banks to do so would be to sell loans on the syndicated loan market. And what's nice about this is that unlike equilibrium outcomes of the loan contracting process, banks can unilaterally sell loans rather than negotiate with the firms that they work with. So this allows us to isolate banks' expectations in yet another way. Okay, so what we find here is that one, we show that lenders with high exposure to GHG emitting firms take less part in Harvard firms' syndicates and are more likely to sell loans. So in line with this idea, we show that shadow bank share for the affected firms goes up significantly after the bill passed the U.S. House of Representatives. This again comes from the private firms in the sample. Okay, so in the rest of the paper, I'm going to skip this part because I'm out of time. But in the rest of the paper, we also estimate placebo tests, and we find results that are in line with the fact that there is no anticipation that is going on. For the Waxman-Markey bill, we also find that there is a reversal of our main findings after the bill failed in the Senate. Okay, so finally we look at some firm balance sheet effects, and we only look at those for the California cap and trade bill because we can only observe that data in that time frame. We showed that firms affected by the bill increase their cash holdings and they invest more as well right after the bill passed. But these effects tend to revert to the bill's pre-passage levels following the bill's implementation. Okay, so just to briefly conclude here, we show that banks act swiftly to reduce transition risks. We also show that banks require additional compensation to bear these types of risks. Banks tend to also lower their syndicate participations in favor of shadow banks. And overall, what we argue based on these results is that transition risks are not likely to pose systemic stability risk for the banking sector. We also show, in this paper, that the effects that we find are concentrated within the subsample of private firms, and this evidence is useful for the design of cap and trade bills going forward. Thank you very much.
Thank you, Ivan, for the presentation. That was really nice. And great work with this paper, especially finding these concentrated effects in private firms. I think those are just so hard to study given the data availability. So that is really, really interesting to see. Okay, just as last time, I think our Q&A section is still quiet. So again, I would just say we wait a minute to see whether something comes up now. Otherwise, we'll just move forward slowly and reserve some more time for questions in the end. I see a lot of participants with no questions, so perhaps that is the way to go. So maybe if that is possible, if we can bring Enrico on stage already, then I would say thanks again, Ivan, and we'll move forward to the next one. Yeah, so next we're going to have Enrico Mallucci, also from the Board of Governors. And he's going to present on sovereign risk. So let's see if we can pull the slides up.
Hi, can you hear me? Can see me?
Can hear you.
All right, yes, so thank you very much for including my paper in this session. So this paper is about natural disaster, climate change, and sovereign risk, and it will remind you a bit of the paper that was just presented by Toan. So let me, well, the usual disclaimer apply, but let me drive you a bit through the motivation behind this paper. So together with the co-author, right, and Mattia Piccarelli, we have been working for quite some time now on a very ambitious project in essentially that aims to review and provide a comprehensive overview of domestic default episodes since the 1980s. And one of the conclusions we reached in this project is that a wide range of shocks may tip countries with fiscal vulnerabilities in a sovereign debt crisis. And these shocks can be domestic, so the usual stories about banking crisis and political uncertainty precipitating a country into a sovereign default. You can have international shocks, such as fluctuation of commodity prices or fluctuation of the risk-free rate. So this is the usual story of a collapse in, the oil price that messes up the balance of payment of a country and ultimately triggers the sovereign debt crisis. But then we also realized that there are a wide number of default episodes that were triggered by disasters. And by disasters, I mean pandemics, wars, and natural disasters. And surprisingly, there is very little literature about it. Essentially, there is now a bit of a literature about wars and sovereign defaults by Horn, Trebesch, and co-author. There is a little bit of interesting now about the pandemics, of course, because we had COVID. So now there is a small literature about pandemics and sovereign defaults. But then there is really very little about natural disasters. And actually, I think that my paper and the paper of Toan are the first two papers on the topic. So on the linkages between sovereign risk and natural disaster, and especially when, especially I'm referring to papers that have more a theoretical angle. And the fact that there is so little about the interaction between natural disaster and sovereign risk is especially surprising, given that natural disasters have actually played a salient role recently. So there have been a number of defaults, like the one of Moldova, Ecuador, Suriname, Grenada, Antigua and Barbuda, in which there was a clear interplay between natural disasters triggering some kind of economic recession and ultimately leading to a default. And it's also surprising given that there is now strong evidence that vulnerabilities to climate change are already affecting the borrowing cost now, especially the IMF is doing some studies about that. And of course, the interrelation between natural disaster and sovereign default is especially interesting, given that we expect that with climate change and the ongoing climate crisis, the frequency and the intensity of this natural disaster is going to increase. So it's going to be more and more relevant in the future. And finally, as a policymaker, I think it's very interesting, this topic, because there has been lots of interest from to try to understand how to incorporate the natural disaster risk in the macroeconomic risk management. So, so this topic is very interesting. The natural disaster affects a wide range of countries, but where the relation between natural disaster and sovereign risk is especially visible is in Caribbean countries. And this is because Caribbean countries have two features that make them stand out. First of all, they are regularly hit by major hurricanes. This is one of the most extreme forms of natural disaster. And second, they are small countries. So natural disasters, they don't just have a local impact, but they have a nationwide impact. So they have a direct impact on the fiscal stance of a government, which is, of course, something that is decided at the state level rather than at the local level. And the interaction between sovereign risk and hurricanes and natural disasters in the form of hurricanes is so interwoven in these Caribbean countries that some of these countries, they have become to issue bonds with disaster clauses, exactly because they acknowledge the strong link between natural disaster and sovereign risk for them. They are starting to write contracts that protect them against this kind of risk. So in particular, they have these disaster clauses that offer a debt moratorium if the economy is struck by natural disaster, meaning that essentially this country can postpone payments related to servicing the debt for a number of quarters when they are hit by hurricanes. And also official lenders such as the IMF have endorsed these disaster clauses as a very effective tool to manage sovereign risk in times of natural disaster and in times of climate change. Now, what my paper does is studying this issue of sovereign risk and natural disaster through the lens of a standard sovereign default model, a quantitative sovereign default model in the tradition of Eaton and Genslovitz. So what the paper does is try to answer the question how do natural disasters affect sovereign risk? How will climate change affect government borrowing terms in the future? So how will this relationship evolve over time? And finally, can disaster clauses help? So can the policy tools that are being used now to address this kind of issue, can they actually help these countries to mitigate the interaction between sovereign risk and natural disaster? And as I was mentioning, I answered this question through the lens of a sovereign default model that I calibrate to a sample of 7 countries. All of them are Caribbean countries: Antigua and Barbuda, Belize, Dominican Republic, Dominica, Grenada, Honduras, and Jamaica. So, in a nutshell, what I find is that natural disaster reduce government's ability to borrow. Climate change will further weigh on the ability of the government to issue debt. And disaster clauses may improve government access to financial markets, but they also lead to overborrowing, meaning that debt limits may be needed in conjunction with disaster clause to achieve what is optimal from a welfare standpoint. So let me guide you very briefly to the model. I don't think this is the forum to be overly technical. So let me just highlight how the model works. So this is an endogenous sovereign default model, Eaton and Genslovitz, with a benevolent government that takes the decision of borrowing and default in order to maximize the welfare of it. So essentially, the government knows everything about the economy, has perfect foresight, and given the realization of income and shocks in a given period, takes the borrowing decision, and at the same time, it decides whether to default or not. And the decision to default is optimal. So when the government decides to default, it is because it improves the welfare of its own citizens. as it is often the case in this kind of class of model, there are two costs of default. The first one is that government that default are excluded from financial markets, so it means they cannot borrow until they gain access again to financial market. And second, there is an output cost of default, meaning that output declines by a certain fraction due to the fact that the government is in autarky. And, the main modification that I do to the model relative to a standard sovereign default model is that I introduce long-term debt as in a chondo, and this is needed to actually to actually match at the same time spread level and debt level that we observe in the data. And this is necessary because essentially I want to run some counterfactual exercise, so I want to make sure that my model works well, and therefore it is able to match spread and debt to GDP level that we observe in reality. And second, I introduce natural disaster in the form of exogenous disaster risk affecting the environment. And here actually maybe you can see a bit of the difference between my approach and the one chosen by Toan. The one chosen by Toan, they really have capital in the model, which I think is really interesting. So they have a growth model for the interaction between sovereign risk and climate and natural disaster. Here instead I take a business cycle approach in which I leave the capital side unmodeled. The calibration, as I mentioned, is calibrated to reproduce 7 Caribbean economy. What is interesting is that I calibrated the disaster risk parameters, so the parameters that define disaster risk, to reproduce the frequency and the intensity of major hurricanes. And by major hurricanes, I mean hurricanes category 3 and above. I choose to calibrate the disaster risk parameter to this, especially to these hurricanes, so those of category 3 and higher, because there is a long literature saying that essentially there is some nonlinearity in hurricanes. Hurricanes that are category 1 and 2, they don't really cause much damage to the economies and to the infrastructure, while those above category 3, so 3, 4, and 5, they actually cause severe damage. So these are the ones that actually matters from an economic standpoint. And then I calibrated the income and process parameter to replicate GDP data for each of these countries in the period 1980 to 2019. And of course, then I have 2 parameters that are important in this literature, the discount factor and the output cost of default, that are jointly calibrated to match spreads and debt to GDP ratios, so that my simulation give debt to GDP ratios and spread level that are consistent. Okay, so let me jump to the quantitative analysis. Essentially for the rest of the presentation, sorry for the slide, I'm going to focus on 2 things, spreads level and debt to GDP ratio, because they are going to describe well government access to financial markets. So the first thing I want to show is that the data and the data replicates the model replicates the data very well. So at the top you have spreads. You have like the darker bar, which is what the model gives me, and the lighter bar, which is what the data says. And you can see that essentially the model replicates perfectly the spread that is in the data. Same is true for the debt to GDP ratio. So given that the model works well to reproduce the reality, then I can run some counterfactual exercise and see what happens if I eliminate hurricane risk and if I have instead climate change. So the first exercise is removing hurricane risk. So suppose that these 7 countries, sorry I didn't mention, each of the bars represents one of the countries. ATG stands for Antigua, JAM stands for Jamaica, and so on. So the first counterfactual exercise is suppose that in each of the countries, the probability that each of these countries is hit by a hurricane drops to 0. What happens to them? Well, you can see what happens here comparing the left bar with the right bar for each country. So you can see that if this country didn't have hurricanes, then they would experience lower spreads, and their debt to GDP ratio would increase. Okay, so meaning. Or I'm going to go back, meaning that essentially the government would experience a better access to financial markets and could borrow more. Now, the second exercise is what happens with climate change. And to see what happens with climate change, I suppose, following the literature, that the frequency of hurricanes increases by 29.2%, and at the same time, the economic cost of hurricanes increases by 48.5%. And what we find, you can see it here, checking the green bar for spreads and the pink bar for debt to GDP. You can see that relative to the baseline model, you have much higher spread and much lower debt to GDP ratio. Okay, so altogether, these results suggest that hurricane risk restricts government access to financial market, and that hurricane risk makes debt to GDP ratio smaller and spread higher, and climate change will further restrict government access to financial markets. So this is to say, essentially, that climate risk matters for the government and for its ability to borrow and therefore to smooth consumption over the cycle. So this is, let's say, is the first part of the paper. But then the second part of the paper is really about trying to understand whether these disaster clauses that are used are actually effective to mitigate sovereign risk, climate risk on sovereign. And the way I model disaster clause is I try to be as close as possible to what we have in reality. So disaster clauses are modeled as clauses that allow government to request a one-period moratorium when they are hit by hurricanes, and the government can choose whether to activate it or not. And the key thing here is that while there is an output cost of defaulting, here, when you have a disaster clause, there is no output cost of activating the hurricane clause. And this is what happens when you have the disaster clause. Here is the price function for the government debt as it was in the baseline model. And here is the price function for government debt when you have the hurricane clause. So you see that for most levels of debt, this curve shifts up, meaning that governments face better borrowing terms when they are hit, when they have a hurricane clause. So one would think that spreads should be lower when you have a hurricane clause. However, the presence of the hurricane clause also has an impact on the borrowing levels. So here you have borrowing levels for the government. You see that they shift up as you introduce the hurricane clause, meaning that government at the same time face better borrowing terms, but also they increase their debt levels, and in the end, the effect on the conditional prices of government debt is plotted here. And you can see that despite the fact that the government was facing better spreads, it actually borrows so much that in the end, prices and therefore spreads are going to be higher with the hurricane clause. So you see that this hurricane clause has this kind of double-edged effect, in which on the one side it improves the condition to which the government borrows, but at the other side it actually makes it borrow too much. And indeed, and I'm gonna go to the final part of my presentation, what I find is that, sorry, I'm gonna just jump to the conclusions here. I'm actually gonna stay here. What I find is actually that the welfare effect of this policy is not ambiguously positive, because indeed the government tends to borrow so much. So in conclusion, what I find is that disaster clauses, they are welcome because they improve the government ability to borrow. So they allow government to borrow at better condition, but debt limits also need to be put in place to avoid overborrowing. This concludes my presentation.
Thank you, Enrico. A very nice presentation as well. So with that, we're at the end of the papers to be presented in the session. So as far as I see, it's still quiet. And again, I think we'll just give it a moment to see whether any questions come up for you, Enrico, but also maybe just an encouragement to the audience. So if anything still comes to mind with regard to the previous presentations, then feel free to bring that up. Yeah, and while we still give it a moment, maybe it's all great. There's something coming in here. Several actually. Okay, so first of all, Amy Franklin is saying, very interesting presentations. They report the power of different policy instruments and suggest a strengthening of the effect over time. While encouraging the size of the effect suggests that these novel instruments will have weak impacts on long-term sustainability. Given a growing appetite by individual investors for ESG funds, is there potential for modest increases in greener holdings by institutional investment firms? And so not sure if this was directed at Enrico. I would say probably not. Let's see. Yeah, I think this could, I mean, most directly to Jean-Stéphane's presentation, but potentially also one of the other speakers will want to speak to the broader question, since we have time to go beyond the focus of the papers. Let's see. Yeah, no, Enrico, please go ahead.
Yeah, no, I find this question interesting. I know it's not exactly directed to my paper, but this is actually one key thing I'm also concerned about, when we talk about sovereign risk, right? So the appetite of investor for bonds, for instance, that have a disaster clause, right? So I think there is appetite for these bonds, but it's true that they really raise the question of how sophisticated must investors be to actually price and manage risk connected to these bonds. So in my view, I think there is definitely lots of appetite from investor about this kind of sophisticated either ESG bonds, ESG instruments, or in my case, bonds with a disaster clause. But I wouldn't be surprised if investors need to step up a bit their ability to manage and understand these instruments before they actually become widespread.
Yes, maybe we can see if Jean-Stéphane is back around, because I think he might also be able to just speak to the broader question. And thank you, Amy, for asking it. Otherwise, I think two comments / questions for you, Enrico. So one is by Anna, and she says, "Great work," and praise.
Sorry, I had difficulties coming back from the hyperlinks. Can you hear me?
Yes, we can, and thank you for jumping in. So maybe, do you see the question asked?
Yeah, so a great question by Amy Franklin. So, well, in fact, there is clearly a growing demand for ESG investments. The key issue is to know to assess whether the financial industry will be able to supply quality products to answer this demand. So there is a key role there for strengthening regulation in terms of creating reliable labels and ways of controlling that these labels are indeed respected. So this process is ongoing in Europe, but there are still many issues that have to be solved. And clearly, another underlying issue behind your question is whether disclosure is the whole story. No, in my view, it's not the whole story. It's useful. It's useful for many reasons, including for giving us interesting research questions. But clearly, we would need other instruments, and we cannot solely rely on improving disclosure of firms and of investors to reach our climate targets. So many other tools, macroeconomic tools, like, for instance, price path for carbon, and other tools are required.
Excellent, thank you. Sorry, I still see my audio is not ideal here. Okay, so 3 other questions for Enrico. The first one would be a comment, but I think implicitly there is a question there, which is Anna's comment saying that there's lots of endogeneity on hurricanes and access to finance. Thinking of the Caribbean, do you have any thoughts on this, just in terms of, how you think about that in the setup of the paper, Enrico?
No, it's a very good point. So my paper is more theoretical. So I think I would be more worried if I had used data in my paper. I believe there is endogeneity there, but this is why I analyze this issue using a general equilibrium model that should take into account should be able to replicate the endogeneities that you observe in reality. Of course, if you believe in the power of general equilibrium model, which they are subject to assumption, of course.
Yeah, that makes sense. And then one other comment by Marianne that I think may also be answered by several speakers, but it directly relates to your topic as well. So Marianne's comment saying, these presentations make me wonder about impact on community assets, schools, parks, libraries. Does the sovereign default model include bonds used to fund these assets, which are often impacted by natural disasters?
So the model is very simple. So it doesn't include different types of assets. There is only one type of asset, that is government bonds. But the way government bond is used is to smooth consumption, meaning actually providing goods for the communities in bad time. Here we are talking about community assets, which are a very special subset of goods. The detail of the model doesn't allow to make any real conclusion about them.
Yeah. And that's also good to understand, or it's good to understand the limitations. There's one more question about the details of the model by Toan, so maybe he can ask the question himself.
Oh, yeah, Enrico, I'm curious because in your model, there's an interesting interaction between the debt dilution risk and the default risk, right? And I think the debt dilution was one of the reasons why the effects of the introduction of disaster clauses is non-trivial. Is that correct?
I'm not sure, actually. I'm not sure, because I tried to solve the model also without long-term bonds, so ruling out that dilution, and I still had the results. Now, I think what comes at play a bit is also how you define welfare gains, right? If you compute them over the cycle or comparing to equilibria. So that one is might actually be an issue, and I was actually asked by a referee to do that, so I'm going to work on it on this in the coming months.
Great. Okay. With that, I would say thank you very much again to you four as our speakers, but also to all of you as the audience. So thanks again for tuning into this session. What's up next is for more sessions on all things climate adaptation. Maybe one important note, or one note for this specific audience, which may be particularly interested in finance and firms. So there are several papers on that topic in session 2.2 on responses to forecast. Yeah, but with that, I'd say thank you very much, and hopefully see you in one of the next sessions as well.